All right, everyone. I want to say welcome to today's or tonight's webinar, I should say, Q2 2025 market update for multifamily investors. This is one of my favorite webinar series that we do that I like to do on a quarterly basis to basically update our investors, whether you're active or passive, or you're a fund manager, or you're one of our partners, on what's going on in the market, right? Kind of lay the land, talk about what's going on in the economy, what's going on internationally, what are we seeing in the media, and then we're going to go deep into some data. I'm a big data person. I like to look at the numbers, and I personally believe that numbers tell a story, right? So we're going to go deep into the data, and I'm going to give you my opinion. And I'll start by emphasizing that it's my opinion on what we're seeing in the market based on the data, and then also what I think may happen, and not that I have a crystal ball, based on some of the data we're seeing. So let's dive right in. If it's your first time here, I want to say welcome. There is a Q&A box at the bottom of your phone, or if you're viewing this on an iPad or your desktop, there's a Q&A box. Please put your questions in the Q&A box. I will do my very best to answer them at the end. If you can't hang around the whole time, just so you know, the recording will come out usually tomorrow. Our team will send it out. And if I didn't get to answer your question, or if I did answer your question and had to hop off, you'll get to see it on the recording. So thanks to everyone for joining. If you want these slides, you see something you like the data, shoot us a text. This number 281-559-7061. Just say, hey, Brian, can I get the slides from tonight? And drop your email in the text, and I'll make sure you get them as well. Let's get to it. Just a quick disclaimer. I'm going to go ahead and go off here. Just a quick disclaimer. This webinar is for educational purposes only and should not be considered legal or accounting or investment advice. We're here just to talk about what we're seeing in the market, some news headlines, things of that nature. And it's not an offer, obviously, solicitation to sell securities. A little bit about us. If you've never heard of us, where have you been? Headway Capital is the name of our firm. We're a private real estate firm based here in Houston, Texas. We provide investors the opportunity to partner with us on commercial real estate transactions. So our firm was created to help build and protect the wealth of busy professionals. And our mission is to offer our clients, our investors, opportunities that provide cash flow, equity upside, and tax benefits to help people like you and me achieve financial independence. So we have lots of experience in the real estate market. We've been investing in real estate as a team since 2011 and in multifamily since 2015, and did our first project where we brought investors in to partner with us at the tail end of 2017, beginning of 2018. So going on about 8 years now. So time does fly. My name is Brian Alfaro. I'm the Director of Investor Relations here at Headway Capital. I also play an extensive role in our marketing for our asset management company, our property management company. I love everything marketing and customer service related. My job is to talk to all of our wonderful investment partners that have trusted us with their hard-earned capital, and to make sure we're providing timely reports, and to make sure that all the communication is going out like it should, and to also let new investors know how they can work with us. So if you haven't spoken to me, feel free to send me an email, investor@headwaycapital.us. It'll go to our team, who will reroute it to me. Just let them know you saw us on the webinar today and you would like to schedule a call with Brian, and we'll get you taken care of. Sid and Anam launched Headway back in 2017. Sid is a former oil and gas executive and the founder and CEO of Headway, still extremely involved in the day-to-day asset management. He lives and breathes operations almost to a fault, I would say. Sometimes he's so deep into the operations, he can be challenging to get a hold of for me, because he's so focused on making sure these assets perform, which is exactly what you want out of your CEO. And then Mr. Umar Nakvi is our CFO, CIO, who makes sure that our properties are performing to the financial aspects that they're supposed to. The Headway difference. So if you haven't partnered with us, or you haven't heard of us, we've been around, like I said, for about 8 years. We have a little over 440 million, so almost $500 million of assets under management, which equates to about 2,800 units. And we're always targeting 20 to 30% average annualized return. So we try to double investors' money in 5 years. That's always our goal. And we have over 500 active investing partners that have partnered with us before. You see some testimonials here, some examples for some investors that have partnered with us on projects just like this one that you see on your case studies. These are the types of deals that we typically look for: value add multifamily deals, some newer construction deals, which you see between the Edge and Esperanza, and then some older deals like Watermill. We do it all. If there's value to be created and we like the deal and we feel like there's returns to be created for our investors, we take a stab at it. So let's dive right in. Enough about me, enough about us. You're here for a market update You're likely a real estate investor looking to transition into multifamily, or you're a multifamily investor. Maybe you're a passive investor or you're an active investor, and you're curious what's going on. So let's take a look at what's going on in the market. So let's lay the land first, real quick, and let's talk about just the overall market, right? Because I think understanding what's going on in the market uh, really influences your decision as an investor, right? Am I investing in stocks? Am I investing in Bitcoin? Am I investing in gold? Should I be in real estate? Am I pulling money out of one place and putting it in another? You really have to stand uh, politically and geopolitics and economics. What's going on from a bird's eye view, not just looking specifically at real estate, right? Real estate is just one piece of the equation when it comes to the economy. Right now, I would say these are probably the top three headlines that we're really seeing across the board. And I don't think anyone has not seen these. You're sleeping under a rock if you do. If you haven't. So today, these are some headlines from today. For example, everyone's talking about tariffs. We're not going to spend tonight talking about tariffs in particular, but it's a hot topic and it has definitely impacted the market. I would say it hasn't necessarily impacted the market the way we thought it might have, because everything's at an all-time high still, and we'll talk about that here in a second. But it's still a hot topic, and it's definitely influenced the Fed to not cut interest rates. So we'll talk about that as well. On the right, you see Trump, a picture of Trump on the 4th of July signing the Big Beautiful Bill, which I labeled the BBB, which has a lot of positive impacts for multifamily investors or commercial real estate investors. Again, this is not a webinar about that in particular, but it is definitely impacting the market. It's a big conversation topic right now. And then last but not least, kind of quiet down a little bit, not as front facing as it was a few weeks ago. But everyone is still looking at all the, the politics and the geopolitics and the international conflicts that are happening across the world, between Israel and Iran. And these things obviously impact our markets. We don't want to be in a war. We don't want other countries to be in a war. War is not good for anyone except for the people that are making the guns, right? So these things are constantly influencing the market right now, and things that we're keeping a close eye on to see how they impact things like the stock market, right? The S&P 500. This is really interesting. This on the left-hand side, you'll see this is a screenshot I took on my Q1 2025 multifamily update. In in April, the S&P 500 was at $5,300 and some change. As of today, it's at right under 6,400 bucks, 6,358 to be exact. I took this a few hours ago. That's a huge gain in the S&P 500. So the market is on fire, and everyone thinks it will never go down, right? So I've seen this movie before, but everyone just continues to ride the S&P train. Everything's at an all-time high. In this headline from today, you'll see the Dow jumped 500 points. S&P 500 closes at another record on Trump trade deal optimism live updates, right? So everyone's super optimistic that these tariffs aren't going to have a negative impact like they thought they were. We're not going to get into war. The Trump's president, so business is amazing, and everything's going to be great. And the stocks are reacting like it, which is interesting. And you're seeing the same thing with Bitcoin. So on the left-hand side, April 2025, Bitcoin was at 93.7K. Today, a few hours ago, it was at 117K. So we all know Bitcoin is extremely volatile, but the fact that Bitcoin is surging as well is an interesting feat in the market. Again, right now, it seems like all your equities and your major blue coin cryptocurrencies like Bitcoin and Ethereum's the same, are kind of on an all-time high or approaching all-time highs in different blue chip crypto, right? So it's interesting to see that the market is very bullish right now. The market's very excited. Lots of people have their money in equities, and they feel like it's a party that's never going to end, right? And we're seeing gold stable because of that. So gold is something that typically people sort of flock to when they feel like there's a lot of volatility and when they feel a lot of uncertainty. And you usually see gold spike. Now, gold has come up, but it is still relatively stable compared to some of these other, Bitcoin surging, S&P surging. Gold has been pretty steady. So how is that impacted? How have these things like tariffs and Iran and the stuff Trump's been doing with the big beautiful bill and some of the other policies he's working on, how have they been influencing arguably one of the most important things, that is the treasury market, right? So the people that the interest rates, the interest rates that we get for our debt Um, that is really, really, really based on a few things. One of them is the treasury. So the 5, the 7, and the 10-year treasury are what really impact the mortgage rates that we get for our big commercial loans, right? And the 10-year treasury has been bouncing between 4.25 and 4.5, really most of the year. When Trump got elected or I should say inaugurated into office, we did see it slightly decline. March, was kind of heading downwards. April, we saw another drop below 4.25, and then the tariff news came out, excuse me, and we've really just been bouncing between 4.25 and 4.5 when it comes to the 10-year treasury, which is not great because we'd like to see it come down, but also not bad because we have stability, right? Really, what we don't want when it comes to getting a mortgage is instability. The rates are the rates, right? I mean, people have been buying real estate for hundreds and hundreds of years. There were times back in the day where, rates were 5, 10, 9, 7, 12%, right? I mean, there's probably people here on this call that have been around much longer than I that remember interest rates in the 70s and 80s, and they were not 4.5%. So we're complaining because we're used to a few years ago they were 2%, 3%, right? So to us, these rates are really high. But what we're really looking for isn't necessarily lower rates. What we're really looking for is stability because we don't want to get under contract and we think we're going to get this rate and then we close 60 days later, which is a pretty typical timeline, and the rates are volatile. They go up or they go down. If they go down, obviously you're super happy, but you're just rolling the dice there, right? So having rates bounce between 4.25 and 4.5 gives us a little bit of stability, but we definitely would like to see them cut. And we're seeing a lot of talk too, because of the rates not being cut, which are impacting the treasuries. We're seeing a lot of talk about, you've probably seen headlines like this about Trump firing Jerome Powell, who is the Fed chair, who is the speaker and the primary person who plays a role in the interest rates, whether they're going up or they're going down, cutting or raising interest rates. For a while, he was talking about firing him, which there's a fair argument to be made that legally he doesn't actually have the power to do that. Some people will tell you he does. Some people will tell you he doesn't. I believe legally he doesn't, but if there's a will, there's a way. I'd like to say, but he's basically kind of backed off that, and he's as of this is from yesterday. So he said he's going to be out pretty soon anyway. So Jerome Powell's seat, yeah, his term concludes May 2026. So we're less than a year away from JP being replaced anyway. And the state secretary was saying that Powell doesn't need to resign, but should conduct an internal review, right? So basically, anyone and everyone that's in Trump's party right now, and a lot of other people that aren't too, are putting pressure on Jerome Powell because they all believe that the data is showing them that we should have already seen a rate cut, right? But JP is basically saying we would have done a rate cut if you didn't implement these tariffs, Mr. Trump. So they are of the mindset, the Fed is of the mindset that these tariffs are, because historically this is true. Historically, tariffs are inflationary. They cause inflation. What the Fed doesn't want, because these tariffs really haven't made their way through the system yet. It hasn't been long enough. What the Fed doesn't want is they start cutting interest rates and then inflation takes off because of these tariffs, right? So they're taking a wait and see approach, which we'll talk about here towards the end of the webinar. And even though other countries are already cutting interest rates, and pretty much a large majority of academic people, people that are way smarter than me, are already saying we should be cutting rates, then they're holding their ground steady and they're saying, nope, we're not cutting rates. These tariffs are going to be inflationary. We just haven't felt it yet. Give us another few months. Give us another few months. Just wait and see. Just wait and see. So time will tell if these tariffs really are inflationary. But for now, there's a lot of media and press and pressure being put on Jerome Powell to cut these rates. There was an announcement, I think, 2 days ago that Jerome Powell was going to have a conference, and everyone was speculating that he was going to resign. There was a lot of talk about him resigning. I saw, I think it was Monday night or Sunday night, I saw just rumors flying about the conference as Jerome Powell resigning, the Fed chair. He came out and he basically just did a normal conference. He didn't resign at all. So again, just a lot of speculation, a lot of pressure being in the seat. So I'm sure he's looking forward to giving it up in May. But for now, he is the man, and he is holding steady with the interest rates, and that is impacting the treasuries and why they're bouncing between 4.25 and 4.5, right? So just something to be mindful of. So how's the economy doing because of all this? Because of these tariffs and these international conflicts and the big beautiful bill and all the things we're talking about with interest rates, what are we seeing in the economy? Well, first of all, let's talk about inflation. That's been the subject matter for basically the last 3 years when inflation started to take off. Really, 4 years ago, inflation started to take off. Where have we went since 2021 till now? So as of June 2025, which is last month's data, we won't get July's data until August. It's always rear looking. Inflation was basically where it should be. You'll see here the dark blue line is all items, and then the dotted blue line is less food and energy. CPI was pretty much in line with expectations. The market was actually forecasting a slightly higher increase in inflation, and it actually came in at expectations, if not slightly below. So that's good news. The market was predicting that these tariffs that have gone into effect since March would have a little bit of a more drastic impact in inflation, but we haven't quite seen that yet. So I'll be really curious to see in July's data or August data, and maybe even September's data, if we start to see an uptick in inflation. But right now, it's pretty much in line with what the economists are forecasting, which is good news. We're not seeing rampant inflation like we saw here in 2021, where inflation got as high as 9%, right? We're kind of bouncing between 2.5% and 3% on a month-to-month basis. But the Fed's mandate, in case you don't know, is to get it at or below 2%. So we're still a ways off. That last 100 basis points, 75 basis points, 50 basis points is the hardest to get it back down. And then you're seeing over here the month-over-month change. So on the right, you'll see the CPI again, but it's just showing month-to-month percent change versus the year-over-year change. June did see an uptick, month-over-month change. It went up 0.3%, which was one of the highest. Was one of the highest this year compared over January, but it's still in line with forecasts. Experts were predicting a 0.3 increase, so it's not like it's rampant. And we were predicting 0.1, and now it's 0.3, or we were predicting 0, and now it's 0.3. It's right in line with where all the economists were forecasting it should be, which is good, and hopefully it stays in check. So inflation is not rampant. It's not running away. It's not a runaway train right now, but it is something we definitely have to keep an eye on as these tariff. I feel like these tariff numbers are moving on a daily basis. Is it 10%? Is it 15%? Is it 20%? Somebody from another country will come out and say, "Oh, now the U.S. has tariffs," and then Trump will double them. So you just never quite know what's going to happen. It's a little bit of a crazy party right now. So it'll be interesting to see how these continue to change on a month-to-month basis. But right now, inflation's pretty much in check. Jobs and wages. So this is really important because most of our renters are impacted by inflation, right? So why are we even looking at this data? Inflation is important, and the job data is important because we have to be very mindful of this when we're buying commercial real estate. We're buying apartments, which is where people live, and they only have so much money, right? The average person is a renter often by necessity, not by choice, right? We're not buying luxury high-rise apartments where people are there because they want to be. We're buying workforce housing, C and B class apartments where people are often there because they don't qualify for a mortgage, or maybe they don't make enough money. They're kind of living paycheck to paycheck. So the job market and inflation is really important. So last month, looking at June 2025's data, monthly job creation actually came in pretty strong. So the forecast was actually expected for it to be lower. If I'm not mistaken, it was expected to be about 110,000 jobs, but it actually came in at 147,000 jobs, which again was a little bit of a surprise to me. I did not expect the job growth to be that high, and they actually revised up May as well to 144,000 jobs. They revised it up. Usually they end up revising it down. Excuse me. The unemployment rate fell to 4.1% last month, which was the lowest since February, and against a forecast for a slight increase of 4.3. So the market and the economists were expecting unemployment to increase in June to 4.3, but it actually fell to 4.1, which is again is a good sign overall. So though the jobless rates fell, it was largely due to decrease in those working or looking for jobs. So we actually saw a decrease in the labor force participation rate. It dropped to 62.3%, which is the lowest level since late 2022. So that's just something to be really interested in the data. This data is very, I'll say, skewed. We're seeing a record low amount of people participating in these surveys. So it's hard to say how accurate this data is, right? When a record low amount of people are participating. So there's something to be really mindful of, but it is good news that the job market has stayed steady because the Fed is mandate is to keep inflation in check and to make sure that we have jobs. That's really their only two jobs, and inflation is in check. We're staying, between that 2.7, 2.9 range, and jobs haven't fallen off a cliff. Of course, coming out of COVID, we saw a record number of job growth. But if we're staying in that, 125 to 150,000 jobs a month, the Fed's going to take that all day long and consider the job market to be pretty stable. The other thing to watch is U.S. wage growth, which it obviously is on a downward decline compared to wages that were rapidly exploding post-COVID, but still relatively healthy at 3.7%, right? Which is important because if wage growth is at 3.7% and inflation is at 2.7%, that's a 1% delta, which you don't want is inflation to be higher than wage growth. That's where people really, really, really get hurt. So the fact that wage growth is still positive at 3.7%, even though it is declining, is a good sign that consumers can, even though it's not comfortable, can absorb some of the inflationary costs that we're feeling due to these tariffs and increase in costs. So, and last but not least is unemployment. As I've mentioned, we ended up at 4.1. This chart says 4.2, but my numbers say 4.1 from the BLS. But 4.1, 4.2, again, still a really healthy number for 2025. So let's talk about the state of the multifamily market, right? So we just talked about a bunch of really important numbers. We talked about unemployment, we talked about jobs and wages, and we talked about inflation, and then we talked about all this stuff going on in the economy overall with these tariffs and the S&P 500 and the market and all that. So how is this impacting the multifamily market? What are we seeing in the multifamily market when it comes to data? This is really important if you're a multifamily investor, so make sure you're definitely paying attention now. So let's talk about supply and demand. So this data is as of the latest report from Colliers, which is a market research company. They're also a broker, a lender broker, and investment sales broker. And this is their latest report that shows a record supply met with even stronger demand. So what this chart is basically showing is apartments are seeing a crazy amount of demand. So it says over the past 12 months, demand, and this is nationally, by the way, this isn't just in Houston, this isn't just in Texas. Over the past 12 months, demand has outpaced supply by 131,000 units, even in the face of record high deliveries. Absorption reached 707,000 units, more than 3.5 times the long-term average. Demand as a share of inventory rose to 3.5%. So with sustained durable demand and a projected slowdown in new supply, market fundamentals remain positive for positive momentum, right? So we are seeing a record amount of supply. So Texas and specifically Houston and Dallas are always in the top five. Dallas is usually almost always number one in the amount of deliveries. So basically, new construction apartments being delivered to the market. Even though we're giving the market a lot of new construction, there's a lot of stuff coming online. We are seeing demand actually outpace that construction. And I think partially some of that has to do with the fact that, or I don't think, I know some of that, and we'll talk about that here in a second, has to do with the fact that owning a home is just ridiculously expensive, right? So we are seeing apartments still be a relatively, an extremely attractive place to live for people that are looking for a clean, comfortable, safe, affordable place to move. And we anticipate that continuing with a market slowdown in new construction delivery. So that is great news that demand is staying above supply. And you'll see here too, new supply sharply declines in Q1 2025, and it's continuing to slow. So as I was mentioning, 116,000 units were delivered in 2025 Q1, but that's a 27% decline from the record high in Q3 2024 and a 6.8% year-over-year decrease, right? So we are starting to see a massive decrease in new supply coming online, and that is forecasted to continue for at least the next couple of years. And that really has to do with the cost of capital right now. All the new construction apartments that you're driving by in Houston and Dallas, where I know most of our investors are from, that stuff has been in the works for years, right? In Houston, if you're talking about buying a piece of land and getting it shovel ready and then building, leasing up and then selling, that's at least a 3-year project, right? So that's like right pre-COVID money. That's like 2022 money, maybe even 2021 money, depending on how long it took them, if they got delays in permits and construction and stuff, right? So the slowdown in the pipeline today, we're seeing a massive decrease in the amount of new construction apartments permits being pulled. We aren't going to feel that until 2027, 2028, 2029. And when there's no new construction or very, very little new construction going on, that's going to make our assets, our existing assets that we own, even more valuable. And it's really going to help us raise rents because there's no new supply to compete against. And it's going to help our overall occupancy as well because there aren't new apartments around a corner, every corner that are offering concessions, 1 month free, 2 months free, 3 months free, move-in special because it's a new construction apartment and they're just trying to fill it up, right? So this is all great news for long-term demand when it comes to the multifamily investment space. What are we seeing across the board when it comes to vacancy? So vacancy is a term used for basically how many empty apartments do we have, right? We don't want a high amount of vacancy. We're always aiming for, I'm sorry, we don't want a high amount of, we want a high occupancy. We don't want a high amount of vacancy, right? So we want our occupancy to be at least 90% once an asset is stabilized. Ideally, we're shooting for 95%, which is about a 5% vacancy rate, right? So vacancy rate continues to improve as demand surges. So obviously the data makes sense, right? If we're seeing a record amount of demand, that should mean that vacancy declines, right? It just makes sense, which is exactly what this chart is seeing. So national vacancy declined to 5% in the first quarter of 2025, which is 90 basis points down from its peak 1 year earlier. So the rate now sits 50 basis points below the long-term average, which is about 5.5%, meaning that we still have a really tight market. So there is a lot of demand for apartments right now. Yes, there's a lot of new construction that can make it challenging to raise rents and to lease right now if you're in a C class or B class space. But vacancy is dropping, which is a good sign as well, which makes the apartment space a very attractive investment. And all markets, all the top US 50 markets experienced a year-over-year decline in vacancy rate. So this is a really big list. Houston is somewhere right over here. So Houston is over here towards the back end. If you're in Houston or you're in Dallas, Austin and Fort Worth are here as well. But this chart shows the vacancy rate for apartments in Houston. Right now, the average, if I kind of run my cursor across, is about 6.5%. So just kind of annotating here. So we've got, for anyone who's maybe on their phone or on a tablet, we've got Houston right here. And if we draw a line, right, for our vacancy for Houston, which is right here across the board, my drawing's bad. It's right above 6%, right? So call it between 6.25% and 6.5%. And then you've got Dallas. So we've got lots of investors from Dallas as well, which is pretty much in line with Houston, maybe slightly above 6.3, 6.4%, still below 6.5%. You've got Austin, which has a crazy amount of supply, about 7%, and then the Fort Worth area is sitting right above that as well. So just really interesting to see how vacancy has declined across the board for some of these major assets, major markets, just because, again, there is an insane amount of supply out there, and that is really impacting us in a positive way. So let's talk about rent versus own, which I was just alluding to. Why is vacancy so low? Why is demand so high? Well, this chart is going to tell the whole story. Right now, the average median monthly payment of a home in the U.S. is $3,037. The average rent payment in the multifamily sector across the board, again, that's going to be nationally across the U.S. and A, B, C class, is 1827. That is a massive delta, right? 1800, 30,000 versus 1800. I mean, that's a $1,210 a month gap. It widened, which is 2.8 times the long-term national average. So this is absolutely crazy, right? I mean, look at this chart. I mean, going back to 2011, even going back to the great financial crisis, the gap between buying and renting was so tight, especially coming out of the great financial crisis. This is right around when the market started to pick up, 13, 14, right? The gap really shrunk. And then COVID hit, which is right around here, Q3, really Q1, Q2, 2020, COVID hit. And then money got really, really, really cheap, which pushed off, made people buy a lot of houses and increased the cost of buying a single family house, right? Because loans were, I mean, if we were in a room and I told you to raise your hand if you refinanced your house or bought a new house in 2021 or early 2022, I mean, probably half the room would raise their hand, right? And that's because interest rates were so low, which increased demand, which pushed up the cost of home ownership. So it just hasn't come back down yet. And the market is frozen, right? I mean, the average days on market for a single family house is at an all-time high for some markets. And some markets, some submarkets in particular, have a record amount of inventory just sitting there. Nobody's buying anything. There's lots of sellers and no buyers, right? It's the crickets chirping. So this massive gap is a record, right? A $1,210 gap, which is 2.8 times the national average, which is insane. So I don't know what it would take to close this. Is it a recession? Is it interest rates? Because I would argue that if interest rates go down and it's cheaper to buy a home, well, prices are going to stay stable or they're going to go up because there's going to be more demand, right? So if this number is holding pretty stable and more buyers jump in, well, won't that increase demand, which increases prices? I mean, that's kind of like supply and demand economics 101, right? So I don't think cutting interest rates is enough to bring this number down. What could bring this number down is some sort of recession, some sort of massive amount of foreclosures, which I just don't see happening like it happened in 2008, or some sort of just other event that we really probably won't see coming if it does happen. Or this could be the new norm, right? And what's likelier to happen, or I wouldn't say likely, or what's possible to happen is this number stays the same, but this number just gets closer, right? So look at where the gap has always been really tight, at least the last, call it 15 years. The gap was definitely larger prior to 2008, which is what you see here. Still not as big as this, but what's likely to happen is this gap closes. Now, will it get this tight? Probably not. Even if it closes halfway, and it goes up $600 and the average rent across the US is $2,400. Sorry for my bad handwriting. That's a massive amount of rent growth that investors can take advantage of if they're investing in multifamily real estate, right? So a lot of theory there. We're not quite sure what would happen, but right now it's almost impossible to buy a house if you're just an average American working a blue collar job, which makes apartments a really attractive space to be in. And obviously because of that, we're seeing a record low amount of buyers on the sidelines and applications remain weak for homes, right? Let's talk about leasing demand. So the multifamily sector posted the strongest first quarter absorption rate since 2000, right? We've already kind of hit that, but this really shows you how much demand we're seeing for leasing in the multifamily space. So Q1 2025, 138,000 is a record amount when the long-term average is 18,400. So again, no surprise here, right? We're seeing a record low vacancy, a record amount of demand, which means we're going to see a record amount of leases, right? So there's no surprise there. Now, what's good, what we're starting to see, and this is really important, especially for us value add investors, is we're finally starting to see a slight uptick in rent growth, right? So rent growth has been basically flat for several months. And on the next slide, I'm going to go a little deeper into submarkets. But since the Fed started raising interest rates and inflation took off, it got really, 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 really challenging to raise rent. If you're doing a value add plan and you're renovating it and you're putting in, $5, $7, $8,000 in renovations, yes, you can capture rent growth. You can get $100, $150, whatever the difference in the market is between a renovated and an unrenovated, classic and a renovated, right? It's still possible to get rent growth. We're talking more about organic rent growth, right? We're talking about just natural rent growth, which historically has always been anywhere around 2%, 3%. In markets like Houston, markets like Dallas, we've been relatively flat, right? So that's really makes it really challenging for us to implement our value add plan. But we're starting to finally see an uptick at 0.8%, which is good news. But let's take a look at specific submarkets, right? This is also really important depending on where you like to invest. It says Midwest continues to excel, West Coast rally continues. But excluding the point, let's talk about, this is year over year effective rent growth for some major submarkets. So let's find our favorite cities. So we've got Dallas right here. And then we've got Houston over here, right? So let's start with Houston. You'll see here the year over year change is the gray dot, and the year over year effective rent growth is the blue line. Houston, which is right here, is relatively flat, which I already knew. We've seen about a 0.2 or 0.2 to 0.3 rent growth this year so far as of Q2 2025. So, I mean, to me, that's basically flat, right? So that doesn't 0.2 doesn't do anything for anybody, right? Dallas, on the other hand, has seen a lot of negative rent growth. So Dallas, if you run this across, is seen about a 2.25% to 2.5% negative rent growth. San Antonio is another one that's gotten decimated when it comes to rent growth. They have also seen about a 3 and some change% rent growth decline. Sorry, rent decline. This makes it really challenging to buy and implement a value add strategy in Dallas and San Antonio. It doesn't mean it's impossible. Again, if you find an apartment, you buy it for the right price, and there are true gaps between the market rent and what the current owner is charging, and you can come in, you can renovate the units. Can you increase the rent? Absolutely. I'm not saying it's impossible, but what I'm saying is we're seeing negative rent growth, organic rent growth in these submarkets. So it's really important when you're looking at deals in these markets to really ask good questions about the rent growth assumptions, knowing that some submarkets, for example, have negative rent growth. Again, it doesn't mean that you can't invest in a deal that has rent growth. It just means that rent growth needs to come from a value add strategy. It shouldn't be coming from people assuming that a rising tide lifts all boats and Dallas is amazing, so we're just going to get a bunch of natural rent growth. That's not happening right now. Houston has been a very resilient market, like it always is. This is one of the reasons we love Houston. Houston is not sexy, but it's super resilient. We've seen that for many, many, many years, even coming out of COVID and especially coming out of 2008. Yes, did prices go down? Absolutely. But it's been a very resilient city. It's a very diverse city. We've got the medical sector. We've got the Port of Houston. We're starting to see more tech companies come in. We've got oil and gas, right? So there's a lot of diversity here, which has made Houston really, really, really resilient city, which is great to see that compared to Houston, compared to Dallas and compared to San Antonio. Houston has been up just a tad, which is a big win in my book. So really interesting, really important to know. Again, continue to look at these submarkets as you evaluate investment opportunities. So let's take a look at delinquency. So this is, we're getting towards the end of the presentation here, and this is really important. So delinquency, I'm not talking about delinquent rent payments. Slide is talking about distressed real estate. So it says distress suppressed by widespread use of extension options, but distress is building. So we have been talking about this for, I feel like a year, if not more, that there are a lot of multifamily loans out there that are in trouble. So it says here the delinquency rate on multifamily loans has risen sharply, though it remains well below the great financial crisis levels. More concerning, these delinquencies represent only a fraction of the loans that may be at risk. So right now, there are a lot of loans that are delinquent, which basically is a fancy way of saying that people cannot pay their mortgage. They're late on their payments, right? Focusing on the multifamily sector here on the left. So this is the Moody's CMBS delinquency tracker. Multifamily is the gray line. It is still significantly below office. It is also significantly below retail. And it is also below other retail that excludes malls, but it is second highest at 4.3% right here, right? So we're seeing amount of multifamily delinquency that is definitely on the up and up. So you can see this curve going up. It is not going down. So we're seeing more delinquent loans. And then over here, we're seeing securitized debt past original maturity still outstanding. So what this is a fancy way of saying is these are loans that are past their maturity. So maturity dates on multifamily loans are, depending on the loan, if it's a bridge loan, the maturity date is usually 3 years. If it's fixed rate, it could be 5, it could be 7, or it could be 10. So when your maturity date is up, that's at the end of year 3, at the end of year 5, or at the end of year 7, or at the end of year 10. These are loans that are past their maturity. So if you got a loan in 2022, let's just say it was March 2022, you took out a bridge loan. It was 3 years with 2 1-year extensions. Your term is due. You're past the maturity of the 3 years. It is due in 2025, right? It's due. If you took it in May of 2022, it's due in May of 2025. If you got a loan in 2020, in May of 2020, well, it is due in May of 2025. If you're a 5-year fixed rate loan, right? These are loans that are past their maturity. It's a 189.2 billion loans, which is not GFC high, but it is still alarmingly high, right? So what's really important to look at is we're going to look at this multifamily section here. The amount of delinquent loans are in the darker sort of royal blue, which is here, and the amount on the watch list are here. Special servicing, which means they're in pre-foreclosure or negotiating with the lender, potentially, is right here. And then loans that are not troubled, that are totally fine, are here. Right. So out of $48.1 billion in multifamily loans, about half of it is okay. Only half. The other 50% is on some sort of watch list, special servicing, or they're just delinquent. Okay. So that means about 50% of the deals out there, if the way I like to think about it, that every 50% of the apartments you drive by are in trouble right now. Okay. So doesn't mean that they're getting foreclosed on, doesn't mean investors are losing their money, doesn't mean the whole thing's on fire, but it means that they are not meeting their debt covenants, they're not paying their loan, and they're past their maturity. And the question is what's going to happen? Well, nobody knows. The lender might end up extending and working with them and saying, "Hey guys, we like you. You're a good borrower. You're past your 3 years or you're past your 5 years, but we want to work with you. We're going to extend your loan. We're going to charge you a small fee for it, and we'll let you just continue to manage the asset. You're doing a good job. Keep it up." And some might take the complete opposite approach and say, "Hey, you guys are past your loan maturity. I'll take the keys, please. Thank you. Have a great day." And they foreclose on you, right? Every lender is different and it is specific to the lender. There's a saying in our industry called loan to own, meaning there are lenders out there that will loan you a whole lot of money, 10, 20, 30 million for these deals as the first position loan, the debt, right? And then they are looking for a reason to take back the property. And those lenders, they're out there and you don't know who they are, unfortunately, until it's too late. A lot of these lenders have, really been formed in the last 5 to 10 years, and we haven't been in a situation like this in the last 10 years. So we don't know all these new lenders that haven't been around for 30 years, what they do when things get tough, right? So some of these lenders are doing exactly what I just said, and they're just choosing to foreclose on their borrowers, even though they might be good borrowers that are performing on the asset. Asset could be 95% occupied. Everything could be going according to plan, value add strategy going to plan. But just because their loan is due and they're not meeting their terms, they can say, "Hey, I'll take the keys back. We don't care if you're doing a good job. I'll take that. Thank you." And then some do the opposite and they say, "Hey, you guys are good borrowers. We want to work with you. We want to do business together in the future. Let's figure this out. Let's work together to find out a plan so you can extend your loan." Regardless, some of that 50%, in my opinion, so some of this 17 plus 5, what is that, 22 plus 2, so about 24 and a half, some of this $24.5 billion, a percentage of that are in lenders that are not very nice. I don't know the answer to that, but that means there's going to be some distressed deals on the market here pretty soon. The lenders might take it back and say, "Hey, we're going to operate it, we're not going to sell it, and we're going to wait for the market to turn around, and then we're going to sell it for a profit." Or they might decide they just want to REO it and they want to sell it, and they're going to sell it for a discount or at note value, and there could be some deals to be had. Right. So definitely a really interesting slide and something to be mindful of, that there's deals on there on the market coming out. And you'll see here on just this other slide, kind of summing up, well, basically what I'm saying is that some loans will be able to absorb higher costs and others will not, which will cause this sort of wave, as I'm talking about, of delinquent loans. So this is the DSCR profile of outstanding securitized debt maturing before 2027. So DSCR is just your debt service, right? Coverage ratio. So it's it's saying how much of your debt can your business cover, can your property cover? What's the ratio, right? Typically, lenders want to see at least a 1.25 DSCR minimum, especially on a refinance or on a going in. They will loan below that. That's typically going to be a bridge loan, but they want to see at a 1.25. Some might even want a 1.3 or higher, just depending on if it's Fannie, Freddie, and the lender. So anything below 1.3 is considered, I would say they call that, high risk, which you'll see here. This chart says 1.25. But looking at the multifamily sector, 56% of the 43.6 billion loans are insolvent. They're below DSCR 1.0. That means they're not making enough money to cover their debt. The other 17%, 12.9 billion, are at 1.25, so they're still okay. They consider that high risk. You're right on the line, but you're still making money. You're making 25 basis points more to cover your loan, which is good. You're making a little bit of money, right? 18% are totally okay. Their DSCR is greater, less than 2, but still above 1.25. And then there's low risk, which is only 9% of loans. So there's a lot of loans out there that are in this sort of medium to high to insolvent risk. What's the amount on that? 43 plus 12 is 55 plus the 0.9. So call it 56 plus 14. So that's a big number, right? So $70 billion, give or take, of loans that are in trouble, right? 60 to $70 billion. So something to be mindful of. I think we're going to see some deals on the market here pretty soon is where I'm going with this. Let me clear this up. And we are almost done, guys. last but not least, why we think now is the time to invest in multifamily. So we've been talking about all this data, right? Talking about all these things going on with the economy, talking about the market, talking about what we're seeing with multifamily, what we're seeing in the real estate space. Why is now still the time to invest? Why should you not be sitting on the sidelines? I'm not saying you should be throwing your money at every deal you see. I definitely don't advise that. I think you need to be very cautious with your investment choices, with not only who you partner with as a sponsor, but the deals you invest in, right? But there's also a bunch of really good reasons to invest. One is the big beautiful bill is back, and it brings back 100% bonus depreciation. I feel like my next webinar should be on this topic. A lot of people have been asking me about this, but the bill that Trump just signed brings back 100% bonus depreciation, which is awesome because this year it was scheduled to be 40%. So your essential tax savings investing in these projects as either an active investor, if you're a sponsor, or a passive investor as an LP, just basically doubled and then some. It went from 40 to 100. So you can take huge advantage of from a tax saving standpoint by investing in these projects. High housing demand and soaring cost of ownership are obviously leading to historic demand for apartments, which we've talked about. And we've seen a massive slowdown in permitting and new construction, which we believe is going to lead to an increase in demand and property values in 2026, 2027, and beyond. As we alluded to, the Fed is taking that wait and see approach to rate cuts due to its belief that tariffs are inflationary, which is upsetting Trump, who is going to be replacing the Fed chair soon when his term is due in May 2026, right? And right now, I think those rates are going to stay high. The higher rates for longer will lead to price dropping and more distressed deals, in my opinion, as we talked about with all these delinquent loans. And I'm almost certain that the new Fed chair will be hired on the promise to cut rates and the market will react accordingly. So, what's likely to happen, and we'll see, is Trump is likely to announce the new Fed chair that will replace Jerome Powell sometime in the near future. It's, his term is due in May. He's not going to announce the new Fed chair in May or April. It's going to be pretty significantly before that. And why would he do that? Well, he's going to do that because one, he's already made it very clear that the new Fed chair is not going to he's not going to put anybody in that position who is not promising, and I'll use that word lightly, promising that he's going to cut rates, right? And once the new Fed chair is in and he's all over the news talking about how he's going to cut rates the second he takes over, the market's going to react, right? So even though the rates aren't down yet, you will see rates start to drop just because they know that the person who's coming in is going to do that. The market is very forward looking, right? It's often forecasting and baking in what's going to happen already in its assumptions. So my guess is that the day the new Fed chair is announced and he's all over the news talking about how he's cutting rates on, the day he takes over, the market's going to start seeing drastic movement, and we're going to see rates go down for multifamily loans and for single family loans as well. And then a wave of loan maturities is coming up, which will lead to a lot of motivated sellers with a limited buy pool, right? So we just talked about all that bad debt, the delinquency here on these last two slides. That's going to lead to a wave of loan maturities and a lot of motivated sellers. And there's a very limited buyer pool right now. We are active in the market. We submit many offers on a monthly basis. Haven't got anything this year yet, but just being selective, and we refuse to overpay for things. So just being very, very careful with the deals that we are making offers on, and then just being careful on what prices we're offering people. But we're definitely active, and there's less and less people active right now. So it's definitely a buyer's market. So we feel confident we'll hopefully find something to present to our investors before the end of the year. So with all that being said, I think now is still a great time to be active. I don't mean, again, active in the sense that you're investing in everything you see, but you should be following this data. You should be following these webinars. You should be following all the stuff that I talked about today and looking at deals that hit your inbox to see if they meet the criteria that you're looking for investing. Are they producing cash flow? Are they risk adjusted? Depending on your risk tolerance. Do they hit your personal investment goals, right? And then are they with a sponsor that you know, that you like, that you trust, that you believe is going to do their very best to not only protect your capital, but grow your capital? But with all these loans coming due, with all these distressed sellers, with a limited number of buyers on the market, I think now is the time to invest. The way I am personally looking at today is I was in college and I was very young in 2008. I didn't have a lot of money anyway, so it didn't really matter that everything was kind of falling apart. I was, in college, right? If I was buying real estate back in 2013 and 12 and 14, when everything was 50, 60, 70% off and everyone was telling you real estate is terrible and Nobody wanted to finance real estate. It was really hard to get a loan for real estate, for multifamily or for commercial real estate, and very few people wanted to invest. It was very hard to find investors back then. Although syndications weren't as popular yet. If we were all on this call buying a bunch of real estate, even if it was single family real estate, we probably all wouldn't be on this call. We'd be very happy because we bought a bunch of really good real estate at a really good price, and we just waited for the market to rebound. Well, I feel like we're in that same situation right now. It's not as bad. The great financial crisis was terrible, and we haven't seen that type of sort of bloodbath in the pricing space. But prices are definitely down in the commercial real estate space. We've seen 20 to 30% drops in prices, sometimes more. Rent growth is flat. It's harder to raise capital. Investors are more nervous. A lot of investors are making money in the S&P and their stocks and different things. So they're like, why would I invest in this, this multifamily deal? I'm getting 20% average annualized returns in the S&P. Well, nothing goes up forever. And we've all seen what happens to real estate over a long period of time if you're patient, right? So I think now is a great time to invest. You should be active and looking for good deals out there. So if you want to invest with us, if you want to get on our investor list, obviously you're on this webinar, so you're probably on our email list, but maybe you're not on our investor circle where you get to see our investment opportunities. This says accredited investors. We do work with both sophisticated and accredited investors, but what I would recommend to you is if you haven't scheduled a call with me, you'll need to do so. Schedule a call to get on our list. Because we work with both sophisticated and accredited investors, we have to have a pre-existing relationship. And just to be honest, even if we didn't work with sophisticated investors, I like having a relationship with all of our investors. So I'd love to schedule a phone call with you so you can see our investment opportunities, get access to our in-person events and property tours we have coming up. But with all that being said, let's open it up to Q&A. If anybody has any questions, now is the time. Speak or forever hold your peace. Wow, everyone's quiet tonight. No questions? No questions? All right, going once, going twice. All right. Oh, just got to thank you. You're welcome, Randy. Awesome. Well, I just want to say thank you to everyone for attending today's webinar. Say thank you to all of our guests. It was always my pleasure to share this information with you. I definitely encourage everyone to stay active and on top of this type of data. Be looking at the S&P, be looking at the treasuries, especially the 5, the 7, and the 10-year treasury, and be reading the headlines, right? Don't always buy the headlines because they're often they have a purpose, right? They're there to scare you, and they're often there to influence you based on whichever company you're reading whichever publication you're reading them from. But gather information, gather data that will help make you a smarter investor. We look forward to hosting you on our next webinar. We do these once a month, and if you have any questions, we would love to schedule a call with you. Scan this QR code, and if you want these slides or you want to schedule a call, shoot us a text 281-559-7061. Thanks to everyone for attending today. And we look forward to hosting you next time. Have a great evening.